Liquidity is the baton being passed between market participants, the liquidity drivers, shaping price movements and ultimately deciding the direction of the market. Think back to the metrics we've covered so far: climactic action, two-way absorption. They both emphasize how institutions maneuver around liquidity. But here's the real question: who's driving the market? In a downtrend, sellers dominate, searching for liquidity, buyers willing to take the other side of the trade. If these buyers overcome selling pressure, they become the takers of sell liquidity, flipping the script. Suddenly, sellers become liquidity givers, and the buyers start driving prices higher in search of new liquidity. The same dynamic applies in reverse during uptrends. This constant tug of war between givers and takers isn't just noise, it's the heartbeat of the market. And understanding it is critical for knowing when to join the winning side. In volume spread analysis, we're often taught to analyze the background, the cause and effect behind price movements. Is there strength lurking in the background, signaling a potential uptrend, or weakness foreshadowing a downtrend? We've already covered one way to spot this through climactic action, but here's another: zooming in on the actual orders coming into the market at critical levels. Whether it's an accumulation or distribution range, liquidity drivers give us a direct view of who's in control. To uncover these drivers, we can use advanced order flow tools like Adaptive Big Trade and Cluster Search. Adaptive Big Trade helps identify large trades in real time, showing where institutions or other big players are entering the market. It highlights clusters of significant trades, offering a clear view of major activity at key levels. Cluster Search works hand in hand with this by analyzing volume and price at a granular level. It pinpoints specific areas where significant buy or sell orders are concentrated, helping us see where big players are building or exiting their positions. For example, if we spot heavy buy-side activity at a low during a range, it's likely an accumulation phase before a markup. Conversely, large sell-side activity at a high often signals distribution before a markdown. These tools give us concrete evidence of who's taking liquidity and who's giving it, adding weight to our directional bias. Once the accumulation or distribution phase is over, we look for signs of strength or signs of weakness to confirm the trend. This is another place where liquidity drivers come into play because they help us align with the winning side just as the markup or markdown phase begins. By waiting for these signals, we can enter trades with confidence, knowing the odds are stacked in our favor. So, this naturally leads us to our next key metric: trend pulse. Once we've identified who's in control, the next step is to measure the rhythm of their activity. Are they accelerating or slowing down? Is the trend gaining momentum or losing steam? With liquidity drivers showing us who's behind the moves and trend pulse revealing the intensity of those moves, we build a complete picture of the market's behavior, one metric at a time.